The company vanished. How did this happen? Billions in shareholder value disappeared after one set of decisions. The risky choice was simple. Protect a cash machine. Do not buy the disruptor. The consequence was irreversible. Blockbuster dominated home video in the 1990s. Thousands of stores, predictable cash flow, franchise royalties, high margins on per-rental economics. The business looked safe. That safety became a strategy. Because stores worked, leaders equated physical footprints with long-term security. Store-level rental economics shaped every plan. Executives, franchisees, and investors saw Blockbuster as a reliable local anchor. Local managers counted on late fees to pad margins. Employees relied on steady hours. Communities relied on familiar storefronts. Then a decision arrived. In the early 2000s, Reed Hastings pitched a radically different model: subscriptions and mail delivery. He later offered to sell Netflix to Blockbuster for roughly $50 million. Blockbuster declined. At the same time, late fees made up about 16% of Blockbuster's revenue. That number is critical. 16% of revenue came from a behavioral tax: customers returning tapes late. The company faced a stark trade-off: cut or cannibalize late fees and accept an immediate hit to earnings, or protect that revenue and delay transformation. Leaders chose protection. They tweaked online offerings. They launched a limited subscription service. They kept the stores and the fees. They did not buy Netflix. They did not dismantle the fee engine. Early momentum hid the danger. Late fees were reliable. Stores turned inventory fast. Same-store cash flows looked strong. Short-term financials held up. Bonuses were paid. Expansion plans proceeded. That positive momentum reinforced the belief that incremental change was enough. But customer behavior was already changing. Mail-order rentals offered convenience and flat monthly prices. Subscriptions removed the late fee penalty from the customer equation. Streaming technology began to make physical returns obsolete. Each development chipped away at late fee opportunities. The revenue model started to show sensitivity to changing habits. The first losses were small but visible. Mail rentals and subscription customers took a slice of late fee income and the occasional in-store sale. Local stores reported quieter nights and smaller baskets. Franchisees pushed for promotions to offset declines. Those pressures increased risk at the store level. Losses grew. Subscription growth accelerated. The flat fee model altered lifetime customer value. More customers stopped generating late fees. Per-rental economics deteriorated. The firm's margins shifted from cyclical weakness to structural stress. The next escalation was larger. Streaming technology scaled. Competitors built recommendation systems and content libraries Blockbuster did not have. Physical demand declined at scale. Fixed costs, leases, inventory, staff became crushing against falling revenue. Store rollbacks accelerated. Debt burdens tightened. Covenant risk rose. A clear turning point emerged when the company consistently chose to defend the late fee machine rather than accept immediate financial pain to secure long-term positioning. The choice not to buy Netflix, combined with decisions to preserve franchise economics and reported earnings, locked Blockbuster into a model that could not flex fast enough. The price of true transformation became actuarial. Buying or fully embracing the subscription model would require accepting a present value loss equal to the cash flow from the late fee stream. Stay with this story. Crisis followed escalation. Mounting losses and unsustainable fixed costs led Blockbuster to file for Chapter 11 in 2010. Assets were later sold. Equity holders were wiped out. Stores closed in waves. Market leadership transferred to those who embraced subscription and streaming. Netflix and streaming platforms captured customers, technology, and long-run economics. The consequences were wide and deep. Billions in future earnings shifted to competitors. Thousands of stores vanished. Thousands of jobs were lost. Franchise owners faced lease obligations and income collapse. Local landlords and communities lost neighborhood anchors. Executives and boards were left to explain a squandered market position, while the rejected sale offer became an unmistakable what if. Forensically, the fatal vulnerability was clear. Blockbuster's earnings depended on a behavioral tax, late fees, that represented a substantial and visible portion of revenue. That dependency made the affordability of reinvention impossible under the prevailing financial framework. Cutting those fees would have slashed reported earnings, harmed franchise royalties, and risked investor and creditor backlash. Those immediate harms outweighed speculative future gains in the boardroom and the accountant's spreadsheet. Institutionally, capital allocation and incentive structures reinforced the failure. Short-term bonuses rewarded quarterly performance. Franchise contracts tied local economics to per-rental returns. Debt and lease obligations penalized store closures. Together, these forces created structural inertia. The firm could not credibly pivot without triggering the very financial damage its leaders feared. The human fallout makes the numbers personal. Store clerks who built relationships with customers saw foot traffic dry up. Franchise owners who had invested in local communities watched revenues shrink. Employees lost steady jobs. Shareholders and creditors absorbed write-downs. Long-time customers lost a trusted convenience. The collapse was not just a corporate failure, it was a social one. The long-term industry effect is obvious now. The distribution and consumption of video moved from physical retail to digital platforms. Content and recommendation systems became the competitive moat. Revenue models shifted toward subscriptions and recurring customer relationships. The market reallocated value to companies that accepted short-term disruption to secure long-term dominance. The final lesson is a forensic paradox. A lucrative revenue line can become the secret that dooms a dynasty. When a firm's present cash flow depends on a behavior that a better model removes, transformation requires paying a large, immediate price. If the price is judged unaffordable, the firm will defend earnings and lose the future. That hidden arithmetic explains how a company with cash, market knowledge, and a clear acquisition offer chose to be disrupted instead of buying the disruptor. Follow the timeline. Learn the warning signs. How a profitable engine turned into a chain around the company's neck is the enduring mystery. The answer lies not in one bad forecast or one failed product. It lies in a set of choices that privilege the present cash flow over the future customer. Those choices sealed the fate of a household name.